So in 11.1, we talked about recording, accounting for purchases, transactions using a general journal. And in 11.2, we're going to talk about recording sales transactions using a general journal. So within this lesson, we're going to account for sales returns and allowances, post a general journal to the accounts receivable ledger and general ledger, and record a correcting entry to the accounts receivable ledger. So let's talk about credit memorandum and for sales returns and allowances. So credit allowed to a customer for the sales price of returned merchandise, resulting in the decrease in the accounts receivable. So before we talked about accounts payable, so stuff we bought that we're going to have to pay later. Now we're talking about stuff, the opposite, so stuff we sold that people are going to buy, because merchandising, we're talking more on the merchandising side now. So of course, as a business, we have to expect some merchandise return. So a customer may receive the wrong item, or they may get some damaged goods, or they may just want to return it because they didn't decided that they didn't want it. So they could, the option is to return the merchandise for either credit on account or for a cash refund. So like I said, credit allowed to a customer for the sales price of returned merchandise, so they can use it at a later time, resulting in a decrease in the accounts receivable of the merchandising business, is called a sales return. Credit allowed for a customer for part of the sales price of merchandise that is not returned, resulting in a decrease in the accounts receivable of the merchandising business, is called a sales allowance. So credit may be granted to a customer without actually returning the return of merchandise. So credit can be given because maybe if there's a shortage in shipment or something like that, then we could maybe do a sales allowance. A vendor usually informs the customer in writing when a sales return or allowance is granted. A form prepared by the vendor showing the amount deducted for returns and allowances is called a credit memorandum. And I believe on the next slide I'll show you what a credit memorandum looks like. So this is just showing here the credit memorandum number is 14, and it's showing that 3 of the 18-watt power tool batteries at $21.95 each are giving credit for that. And we have to include the sales tax because when they bought it, they paid the sales tax for that. So now we're going to talk about how this is going to affect our books and how we're going to journalize that. So sales return and sales allowances are going to decrease the amount of a business sale. So if someone returning something, it's obviously going to decrease our sales. So sales return and allowances is a contra account to the revenue account sales. So it's going to be the opposite. So the normal account balance of sales return and allowances is debit, which of course is going to be the opposite of the sales, which the normal balance for sales is credit. So let's talk about what we can do here. So on December 16th, we granted credit to Lake Automotive for merchandise returned $65.85, which we just saw in the memorandum, plus sales tax for $395 from $500, because that was the original amount, totaling $69.80, and the credit memorandum number was 14. So what could we do? So we're going to debit sales returns and allowances. You're probably thinking, well, why couldn't we just debit sales, right? Well, just like in the last unit when we didn't just debit purchases, we debited the purchases, returns, and allowances because it's better tracking, right? So better information is provided if these amounts are debited directly to a sales returns and allowances. And that way, again, management can quickly learn if the percentage returns of percentage of sales returns and allowances is greater than expected, or again, if it's on a specific item or what. So yes, we're going to go to the contra account of sales, which is sales returns and allowances. So the normal balance is a debit, so we're going to debit that. And then our credit's going to be, we have another debit which is sales tax payable. So again, when we set up the payable, it's a credit, so we need to take that away. So it's going to debit $395 for the sales tax payable, and then we're going to credit the accounts receivable. So because the transaction is not a cash receipt, it cannot be recorded in the cash receipts journal, and since it's not a sale on account, it cannot be recorded in the sales journal. So just like on 11.1, items that cannot be recorded in a special journal have to be recorded in the general journal. So let's just go through. I'll show what it looks like here in the general journal. So we have the 16th date, sales returns and allowances, then sales tax payable are our debits, and then accounts receivable and Lake Automotive. So again, we're using that diagonal line, which is going to indicate that we need to post that to two accounts. So we need to post it to accounts receivable, and then we also need to post that to the accounts receivable ledger accounts of Lake Automotive. And our document number is going to be CM14 because that was the number of the credit memorandum. So now let's talk about posting from a general journal to an accounts receivable ledger. So entries in the general journal may affect account balances in both the general ledger and the subsidiary ledger accounts. Remember, we have that controlling account and then we have the subsidiary account. So the posting of the transaction to the general ledger follows the same steps that we talked about earlier in the chapter. So we need to, if we were to stop mid-transaction, how do we know where to go when we go back to it? So we're going to go back to it by what we can see has been post-referenced. So here you can see we have, for the subsidiary account, we have Lake Automotive. This is the accounts receivable ledger. The general ledger would be accounts receivable, but this is the specific subsidiary accounts that make up that controlling account. So we're going to credit Lake Automotive because that is the subsidiary account, and the normal balance in that account is debit. So if we're going to reduce the amount, we need to credit that. So we're going to credit Lake Automotive because that is the subsidiary account, and the normal balance in that account is debit. So if we are going to reduce the amount, we need to... Sorry, there was some echoing going on there. I'm not sure what was happening, but anyways, I think I got it fixed. Okay, so let's just go through and finish this transaction. So we're going to do G12 because our general journal 12. And then again, to finalize up in the top, that diagonal slash, we need to put the general accounts receivable ledger. So that's customer number 130. We would put that as our post reference. So on December 26th, we found that a sale and account to Skinner College was incorrectly charged to the account of Wells Apartments 334. So it just hit the wrong account. So how do we fix that? So errors may be made in recording amounts in subsidiary ledgers that may not affect the general ledger controlling account. For an example, a sale and account may be recorded in the wrong customer in the sales journal, but as long as it may be right on the controlling account, we just have to switch it within the subsidiary accounts. So the correcting entry recorded in the general journal only involves the subsidiary ledger accounts because it's already right in the accounts receivable. So what's going to happen then is we're going to correct the customer accounts, and we're going to write the date, write the name of the correct customer. So we're just essentially going to switch. So we're going to put Skinner College. We're going to debit that for $334. And then we're going to Wells Apartment, credit of $334 because it was charged to Wells. So if we want to reduce that, we credit it, and we're going to now put it into Skinner. So why can't we just go and delete the transaction? Well, we want to show record and have proof of everything that we do. So we're going to write the general journal page number and the post reference just as normal on both of them. So you see G12 on 8, number 8. All right, so let's just go over it quickly. We have a few minutes here, so I'm going to try to be quick with these so we only have to do one video. So what is the difference between a sales return and a sales allowance? A sales return is a credit allowed to a customer for the sales price of the returned merchandise, and a sales allowance is a credit allowed to the customer for part of the sales price of merchandise that is returned, such as a shortage in shipment. So maybe like they only had 2 of something rather than 3, so they're getting a credit back for that one item they did not receive. And then the sales return is credit allowed to a customer for the whole price because it was returned. The customer's not keeping that item anymore. And like I mentioned earlier in the chapter, the sales return can look like multiple things. It could be just cash or money put back on the card of choice it was paid for, or it could be merchandise credit to use at a later time. What is a source document for journalizing sales returns and allowances? Okay, what did we talk about? Credit memorandum. Why are sales returns and allowances not debited to the sales account? So just like purchases in 11.1, we could do that. We could do the opposite of the normal balance. So a sales account normally has a credit balance because it's a revenue. We could just debit it, but we don't want to do that because we want to be able to track our returns and allowances. So it provides better information, and it's going to allow management to learn if what's going wrong. You know, is that percentage greater than expected? Why? Is it all based on a certain time of year, or is it based on a certain item? It just allows for an analysis to be done, and without having to go through all the sales. Because if it's a big business, you would have a lot of things hitting the sales account, right? By which general ledger accounts are affected, or excuse me, which general ledger accounts are affected and how by a sales return and allowances transaction? So, sales returns and allowance and sales tax payable are debited because, sales returns and allowance, their normal balance is debit, but sales tax payable, normal balance is credit, but we're reversing that, so we need to debit it. Accounts receivable is credited because accounts receivables, normal balance is a credit, and we need to reduce what someone owes us, so they need to credit it. And that is the end. So again, if you guys, I think I have Schoology open. Maybe not. But if you would go into Schoology, I do have a place where you will just take a photo and upload 11.2. So it's going to be on your own 11.2 and application problem 11.2. So once you're finished, like I said earlier, please just take a photo of the item and upload it. You could have multiple uploads, but just so I can grade it and put some grades in the grade book. If you have any questions, again, please feel free to reach out, and I'll be back for 11.3 soon. Okay, bye guys.